Welcome to this week's Weekly Alpha, where we give you the key updates in the digital asset market and provide our perspective on what you need to know as an investor. Now, the three key stories this week are firstly that Bitcoin ETFs experienced $1.5 billion of outflows. The main reason for this is that US CPI came in quite hot at 3.8%, and some analysts are saying that we might see rate hikes in the US. We've got a bit of a contrarian take on this, which is that we think there could be no rate hikes or in fact rate cuts. And the reason why is that the new Fed Chair Warsh has said multiple times that he's pro-growth for the US economy and he thinks AI is going to be a deflationary trend. Not only that, but he's suggested a couple of times that he'd like to use trimmed mean CPI, which is excluding the most volatile assets that can spike during times of inflation or crises. So he wants to exclude those things to focus on trimmed mean CPI. And that would put the current inflation reading at around 2.8, 2.9%. And so we think that's why rate cuts are actually still very much on the cards. And that would be very bullish potentially for some of the risk assets in the digital asset space. The second major story is that the SEC has paused its Innovation Exemption Act for tokenisation. Effectively what this means is that exchanges that were going to offer equities but in a tokenized form through blockchain tokens, they wouldn't have had to apply for full broker-dealer licenses to start doing this. They'd have a bit of a lower regulatory barrier to see this take off. That's been paused for the moment, and so the market did sell off on the back of that a couple of percent later in the week last week. However, we're still very firmly of the view that tokenization is the next major trend that's going to bring trillions of dollars into the digital asset economy. It's just a case of it's delayed short term, but long term we think this narrative is very much intact. The third major story is that Michael Saylor has confirmed that his company's strategy is prepared to sell some Bitcoin to pay the dividends as well as any outstanding debt obligations that the company has. Debt is around 8 billion, but the company holds more than $60 billion worth of Bitcoin, and with the dividend obligations that it has on its preferred shares, it has over 35 years worth of dividend paying capability, even if they didn't acquire any more Bitcoin. So we don't really think it's anything to be concerned about. It's just a case of they have a lot of Bitcoin and they might need to sell some occasionally to pay dividends. So yeah, fine from that perspective, I think. Now, the other major story that we've been keeping an eye on is several senior researchers have actually been leaving the Ethereum Foundation. And what we've noticed over the last couple of years is that following consistent upgrades to the Ethereum network, it's actually become much more cheap and efficient to transact on Ethereum. However, the consequence of that is that revenue generated by the Ethereum ecosystem is actually significantly less. And that means obviously less funding for developers, less funding for new upgrades. And not only that, they've made upgrades to the network which pushes transaction activity onto layer 2 networks such as Arbitrum, Optimism, and Base. And only occasionally do those networks make a net settlement back onto the Ethereum mainnet blockchain. And the price of Ethereum is sort of reflecting this. So it's down 55% from the all-time high, and it's really struggling, I think, for a bullish narrative. Tom Lee, who's the CEO of the largest Ethereum treasury company in the world, Bitmine, is down over $8 billion on his Ethereum treasury strategy. And so I think what we're talking to about with our clients at the minute is just really minimizing your risk exposure to Ethereum. Maybe not entirely, but taking a look at these factors, I think it's important to just mitigate any further pullbacks that we could see in the Ethereum ecosystem. That's it for this week's update, and reach out if you've got any questions, of course, and I look forward to catching you next week.